Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. Josh Knoll here, alongside special guest co-host, Mr. Jay Stubbs of Providence Partners. Jay, how you doing?
Josh, I'm great. It's good to be with you here in studio. A lot going on in the world, but glad to take some of the blinders off with respect to planning for clients, those listening. Maybe you can focus driving around or walking around the house today on some good retirement planning concepts. But yeah, good to be with you, and good to be in downtown Fairhope with a little bit of hint of fall, just the slightest hint
until this afternoon
fall.
Comes around.
I did drive by a bunch of pumpkins and skeletons. I cannot believe that. I mean, it's early September, and here we are looking at Halloween decorations.
The back of Michelle's car is filled with Halloween stuff right now. She's already gearing up. I'm like, it's still summer.
Yeah, it really is.
So,
anyway, good to be with you.
Good. I'm glad to have you. We're back. He mentioned downtown Fairhope, Coastal College's recording studio, ready to put together another great show for those of you tuning in. Listeners, Jay and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, deep dive on our topic of the day. Second segment, roughly 30 minutes past the hour. That'll be headlines of the week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And I've got some predictions around AI that I'm going to try to pull out of Jay for that one. So quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website. That's gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, grab a pen and pad. We're going to repeat it several times throughout this show. Speaking of the show, let's get on with it. So, Jay, today what I wanted to do is I wanted to answer a question that I feel like we get often when we sit down with pre-retirees and retirees. The question is, do I need life insurance in retirement? Most of us, especially those of you all with kids, young kids, and or a spouse, carry some type of life insurance during our working years to replace the catastrophic loss of income for our surviving dependents if we prematurely pass away. But what if the kids are grown and no longer on the dole? What if the debts are paid? What if our surviving spouse has plenty of assets and income to financially survive the passing of a loved one? Do you still need life insurance in retirement? So let's start with the reasons that you might need life insurance.
Well, yeah, and Josh, it's everything. This question comes up. Everything is it depends. How much do you owe some institution, some bank, or some line of credit? Do you have a second home or a third home that needs taking care of? Do you have other expenses that you're going to be responsible for down the road? So it depends on that. So debts, covering debts. It depends on your surviving spouse, and think of it both of there's usually a breadwinner, somebody who has the primary source of income coming into the household versus someone who didn't. So we want to make sure that we're replacing that income, so providing for your surviving spouse. Then there's the consummate final expenses and planning and estate costs. And then, of course, some people just want to have a bunch of assets to leave their next generation. So think about that from an inheritance standpoint. There's two schools of thought. Nope, my kids are going to work for what they want to they're going to work.
I don't want to leave too
much. I don't want to leave too much, so they don't work.
Too much wood on the front porch.
That's right. Then there's the other school of thought of I want my kids to be able to do what they want, and I want to give them some financial freedom. So there's that thought process of leaving an inheritance to kids and grandkids and next generation. Then there's other points where this often comes up in business owner conversation, equalizing. So if you have like a son and a daughter, and the daughter is going to take over the business, and the son is not going to be a participant in that business operation, the income that's generated, well, we want to equalize what is going to be left to that son. So make sure that there's an estate equalization plan. So all of those things come up, Josh, and you made notes on each of these areas. We can kind of touch on them.
That's what I'm going to do. And break it down each one.
Just understand, though, that the life insurance component, a lot of people don't realize this. It is in the tax code written as such. It's tax-free. So we need to make sure that people understand that a life insurance policy is a tax-free benefit. It's been like that since 1913 as it was written into the tax code. So well over 100 years of planning where people need to understand, hey, if I've got a $100,000 policy, a $500,000 policy or more, that's coming in to me income tax-free should a loved one pass away.
Well, let's start with the first thing. You mentioned debt. So, one of the things I want to kind of make clear when someone makes an appointment with us, there's no necessarily super common theme across pre-retirees or even retirees when it comes to debt. Sometimes people that are about to retire, they feel a little bit abashed, if you will, that if they still have car loans or maybe they carry running credit card debt or things like that. Those things happen. It's just because you carry debt doesn't necessarily mean that you're not ready to retire. And probably more often than not, we'll see somebody carry some type of mortgage balance. Especially down here, in Baldwin County, you've got relatively expensive homes a lot of times. So with the life insurance, it's one way to come in, like Jay was saying, provide a tax-free benefit to wipe out those debts. Even specifically for those of you all that are debt-free, and we'll talk more about this, but for those of you all that carry a mortgage, Jay, aren't there some programs that you can tie into the amortization schedule of a mortgage?
Yeah, so
with a death benefit?
Yeah, you can perhaps design a death benefit plan that will closely resemble, not exactly, but closely resemble your schedule of debt as it gets paid down. So just think in terms of if I've got a $250,000 mortgage, certainly, and that pays down over time, let's say 15 years. Obviously, it's paid down to zero in year 15. So the balance owed maybe 5 years in is not $250,000. We can work with insurance companies to design plans, specifically in the term insurance world, to give a plan that closely resembles that mortgage down balance as it reduces. Well,
and then the other thing is you're leaving a surviving spouse. A lot of times, hopefully, obviously, the Social Security is going to be part of the planning. Hopefully, potentially, there's a pension, there's other retirement assets, maybe there's qualified plans. But there is an argument to be made that if you pass away, leaving a large lump sum, because typically, if you're going to carry life insurance, you're going to have at least a decent face amount. Most term life insurance policies now start at face amount of.
We can go as low as $25,000.
Understood.
And sometimes even one or two companies go down to 10.
Right.
In term life. Yeah.
So you're leaving these things for your surviving spouse. Maybe it's a kind of a final gift, if you will, if you're wanting them the ability to go out and do something nice for themselves. To move on with their life. With that, Jay just mentioned the $10,000 and $25,000. Now, I can't speak for you, Jay. I know a little bit about the final expense industry, but those term policies that you mentioned, how do those compare and contrast with like somebody looking for a final expense type of policy?
Term life is something that you go in. Obviously, you buy a life policy, and then it's term, and the term references to the period of premium that's guaranteed. You're buying a 10-year term. That premium is going to be guaranteed for the 10 years for the stated face amount. Whereas a final expense policy, you go in and say, hey, I want a policy that's going to be there when I die. It's no matter how old you are and how long you live, it's going to pay off. Final expense policies can go one of two routes with respect to underwriting. They can be guaranteed issue underwriting for people that are unhealthy and would not qualify from underwriting. The maximum amount of coverage you can get is a $25,000 policy. Usually you have to be 50 years old, no more than 80 years old in order to get that guaranteed issue. And I want to understand that when you purchase that policy, you're just checking a couple of boxes. Mm-hmm. I'm living, I'm breathing, but I'm not in the best of health. I would not qualify. So you pay a premium. You get increments of $5,000 up to $25,000, no more than $25,000. Several companies offer these products. The first 2 years with one company or the first 3 years with another one, it's called a return of your premium back to you if you die in that 2-year or 3-year window. It's called a graded death benefit. And once you hit the 2-year mark or the 3-year mark, depending on which company you go with, then that death benefit kicks in for the $25,000. So final expense can go the path of guaranteed issue, or we can go in there and do final expense for a simplified underwriting capacity, which is when you do that, you're qualifying, yes, I'm healthy enough to qualify for life insurance, and that death benefit kicks in day one that you start paying the premium.
Well, you just mentioned guaranteed issue and simplified issue. I know, at least in the last handful of years, there's been an increase in the age limit that companies will look at for a fully underwritten life insurance policy. Is that accurate?
We can go all the way to age 90, Josh.
Wow. Oh, my gosh.
I was party to a transaction for an 88-year-old lady who was in preferred risk. Now, it was an expensive premium, but
Sure.
she wanted a plan in place that she knew, because when you have a life policy, that's control from the grave. The contract itself has an owner, has an insured, and it has designated beneficiaries. The beneficiaries of that policy are the only ones that would receive that asset or that death benefit. She wanted control, so she was able to put that plan in place and got an approval. So that was many years ago. Yeah, but we can write preferred up to age 90. Several companies look at that. Typically, the maximum age that I have worked on is like 82, 83, 85. There are plans out there, but yes, we can certainly look at it older age markets. So if you're listening to this and saying, "Oh, I'm in that market," and you're interested in a control and having a plan in place, let us know. We'll be able to give you some pricing and some options.
Yeah, don't call Big Al or Sloppy Joe or whatever his name is.
Yeah, on the XM radio or what have you.
Yeah, whatever.
Sirius. Yeah.
And then lastly,
it's Big Lou. by
Big
the
Lou,
way.
thank you. Yeah, Big Lou smokes 5
I
cigars
don't even
an
know.
hour.
Is he even? No, he's fictitious.
He's
Just let
fictitious.
everybody. We are real agents and advisors, Josh. You actually get to have a face-to-face conversation. So while I'm a firm believer in in all insurance planning and the importance of it, September is Life Insurance Awareness Month. So let's bring that out. A lot of people are just comfortable dialing or logging onto the web and getting some quotes and fulfilling their insurance through those means, but you need to sit down with somebody face to face. And I always like to ask somebody says, "Oh yeah, I bought my insurance through 800 number or online through the internet." I'm like, okay, great. Who's the agent that's going to pay the claim? Who is your wife or your husband going to call to get that claim processed when you pass away? Because it's not if, it's when.
Yeah, fair enough. And then lastly, you mentioned inheritance. So as a father of 3 children, I always tell my kids, I don't love you equally, I love you uniquely. And so a lot of you all are listening, if you've got multiple kids, and let's say that you've got a significant amount of your net worth tied up in physical assets like real estate or a business, it's almost impossible to, the old Bible story of splitting the baby. It's almost impossible to split the baby perfectly. So talk a little bit about how life insurance can come in and kind of help equalize that inheritance across multiple children or multiple heirs.
Yeah,
Children.
let's say earlier in this episode, we said that the daughter was going to run the family business moving forward. She's the one that wants to do it. And let's say the business is valued at $1 million. Her brother, the son's not involved in that business. He has his own operation or working for his own situation. You may want to create a plan that equalizes the inheritance, where daughter gets $1 million of a business, son gets $1 million of liquid asset. Some way, shape, or form to make that happen. We see that a lot in planning, especially for closely held business, family-owned businesses down here along the Gulf Coast and in South Alabama. There are a lot of multi-generational operations that have been around for many years, and I 3 and 4 generations long, sometimes longer. You want to make sure that everybody has a good Thanksgiving and Christmas when they're all sitting at the table, making sure that everybody feels equal with respect to mom and dad's inheritance plan and estate plan. And remember, every single person has an estate. There have been some changes with respect to the big beautiful bill that just been went into effect. Estate taxes and the that world is we're not talking about it specifically today, but if you find yourself having a large estate, whether it's an asset size or just liquidity, you may need to have a conversation with us about having an estate plan, an estate tax plan. So if you got multi-millions of dollars, it doesn't necessarily mean you're going to have an estate tax problem, but you could if you look at it from the growth perspective and over time. But at the end of the day, we want some control.
Well, plus too is like you said, we're not diving in too deep, but the estate tax exemption amount is always a political football. So just because it's super high right now, by most people's standards, the definition doesn't mean it's going to stay that way.
Exactly. It could change, and be different 10 years from now. Also, Josh, I want to talk about people with pensions. A lot of people listening may have that situation where they work for a school or a municipality or government agency or anything that may say, hey, you're going to get a pension at your retirement when you choose to pull the retirement trigger. There are options in your pension plan that will allow for you to choose maximum income on your life alone, meaning, hey, I get the most monthly benefit from my pension, and when I die, there's no more pension left paid to my surviving spouse. Or you can make a decision saying, I want a pension for a lesser monthly benefit, and when I die, my spouse can continue to receive that income from that pension plan, and when they pass away, then that pension is gone. A lot of calculations come out, and you say, well, the difference between the maximum income under Plan A and the income you would receive for joint pension at Plan B, go ahead and take the maximum income if you're insurable, because you can buy a life insurance policy for a small amount of monthly premium to have that asset paid to your spouse, and you can maximize your income. So don't want to confuse the subject too much. Just understand that if you have a pension decision to make at some point in the future, make sure you get a calculation of a pension max. That's the planning concept is called pension max.
And that's something we can definitely help with.
Yep.
So, all right. So the reasons to not buy life insurance, we kind of already touched on it. If you're debt-free.
Congratulations.
Yes, you got sufficient assets, no financial dependence. I think it really boils down to this question, Jay. If I were to die today, would my death create a financial hardship for anyone I care about? Right?
Amen.
And if the answer is no,
yeah. If it's no,
then you don't need life insurance.
That's right. And if the answer is yes, then we have a discussion. Let's also bring this up, though, Josh. People, as they're thinking towards retirement, and we have shows ad nauseum in our past about long-term care planning.
Our extensive catalog.
And several shows where we've discussed long-term care planning. A unique concept that's come around in the last decade is life insurance with a long-term care or a chronic illness rider. And what that means is I've got two birds with one stone. I have a living benefit should I need to pull from that bucket to help offset the cost of long-term care, or if I have a chronic illness event, I can have a benefit that can be tapped into. But if I never have a long-term care event or chronic illness event, then I have a death benefit that is paid to my beneficiaries income tax-free. So a living benefit and a death benefit combo. We do see retirees say, I'm interested in that. I want to be able to leave a little bit of a legacy. Church, school, 501c3, you can think of those different types of beneficiaries out there. Maybe a little money to kids, maybe a little bit of future college money to grandkids. But oh, by the way, I'm going to add that rider on there that gives me a living benefit should I need to tap into it, and I can pull from that bucket for long-term care expenses or chronic illness expenses.
Perfect. All right. So we talked about the reasons for carrying life insurance in retirement, the reasons for not needing or carrying life insurance in retirement. We threw a couple terms around, Jay, but as we're wrapping up segment one, let's talk about the different options that would be available, not just to retirees, but if a listener is sitting there saying, well, okay, this sounds like something I'd like to have a discussion on, but what are my options? What are the different type of life insurances that someone can carry in retirement?
Let's just break it down into two easy product types. There's term insurance, and then there's not term insurance.
I like that.
Okay?
I like that.
We've already said it earlier in the show. Term insurance, you buy it for a specified term period, which means the premium for the cost of that face amount is guaranteed for that 10-year, 15, 20-year window. We can go all the way out to 30 and 35 and 40-year term if we want to. So that's term insurance. There's no bells or whistles with it. You pay a premium, you get a death benefit when you die, if you die within that term period. The not term, there's several different products out there. Not term, some people call it permanent insurance. Mm-hmm. I don't like to use that that phraseology, because it's not all universal life contracts or whole life contracts, especially if you take a loan against it or interest rate sensitivity. It can turn into be not permanent.
Right.
Permanent means going to be there when you die.
Right.
So there's guaranteed universal life. There's whole life, which is guaranteed your whole life. And then there's interest sensitive and index performance universal life contracts that are out there. So there's term insurance as an option, just guaranteeing that during that term period we have a death benefit. And then there's not term. We want something that's going to be longer lasting in duration. I will say that the majority of those rider situations we just talked about are on whole life and universal life.
They are. Okay.
We do have a couple of companies that offer a term with a long-term care or a chronic illness rider. They are out there in the marketplace, but typically they are, they're priced a little bit more expensive than traditional term. So some people just say, hey, I'm just going to get, the regular term. Well, if they're interested in the rider capacity, they have to look at a whole life or a universal life to get the most competitive pricing.
And in general, so a whole life policy is going to have a cash balance, cash value to it that's going to have some type of interest rate. And if it's what's called a participating policy with, for example, like a mutual company,
Yep.
there's potential of dividends placed into that policy.
Correct.
That's going to grow at a relatively, it's kind of your tortoise of cash value policies. It's going to kind of grow at a steady rate, generally speaking.
Current dividend rates are running anywhere from several companies in between 5 and 6%.
Right.
The highest being 6% dividend rate. That's not a guaranteed number.
Right.
It's annually, resets annually.
And then you've got index universal life that you mentioned, where it's going to be similar to a fixed index annuity. It's going to mimic some chosen index. A lot of times S&P 500 is one example.
The most common.
Right. And if that index performs, there's going to be a participation rate to some degree, and then there's going to be some downside protections on the cash value to some degree. There's still a cost of insurance that comes out of your premium, right? Am I describing index universal life correctly?
You are, and in its basic form, it's designed. Index universal life is designed to grow the cash value a little bit better than potentially whole life can.
Right.
And then there's different interest sensitive products and indexed products that are out there in the marketplace. We don't want to overwhelm this radio show topic with that. We just understand that when you are in retirement, if you do want a policy that grows a little cash value for a rainy day emergency side fund, you can do that.
Yes. And then lastly, the last one, you mentioned guaranteed universal life, which I credit you for introducing that product to some of my clients years ago. And to me, it was kind of a nice balance between all this because this is, I don't want to make an overly broad statement, but generally speaking, a whole life policy or an index universal life is going to be more expensive than a term policy.
Correct.
Right? Because there is potential of some cash growth, different formulas, but cash growth. With the guaranteed universal life, generally speaking, you can design that where you've got kind of the benefits of both sides. Is that accurate?
Well, what you're going to get is in a GUL, guaranteed universal life, you're saying, I want a death benefit that's guaranteed to a maximum age 125. People think that they are going to live that long, and we have some
we'll
people.
See it.
Yeah. So you can guarantee a death benefit to age 125. Now, most people want to see a death benefit guaranteed to maybe age 100.
Right.
Age 105, if it's a trust-owned policy, most fiduciary responsible trustees want to see a guaranteed death benefit to age 105. But yeah, you can design a plan. You can say, hey, I'm 60 today. I want to guarantee death benefit with a rider, and I want to see that guaranteed to age 90.
And the point of the GUL is typically not cash growth. It's the longevity of that death benefit at an affordable rate.
There is no emphasis on cash value accumulation. And in fact, you might see zeros on the board, right, across the board. But what you do see is a underlying guarantee of that death benefit all the way out to your predetermined age, and you see the premium that's guaranteed to be that cost for that death benefit guarantee. We see that very common in obviously estate planning, trust-owned policies, and those types of planning. And we see it when somebody says, hey, I want $50,000 guaranteed the rest of my life.
Right.
I want my wife, my kids, my grandkids to be able to have some monies that come in and they can do something with it. That is a lot of people would choose a GUL because they know it's going to be there when they pass away. Very
good. Well, listeners, if you've liked what you've heard so far and you want to set up a follow-up conversation with us at Gulf Coast Financial Advisors, it's very easy. You can give us a call, 251-327-2124, or find us on our website, gulfcoastfa.com. The FA stands for Financial Advisor.com. On our site, there is a blue button in the upper right-hand corner that will put a meeting on my calendar. There's flexible choices for that meeting. It could be as simple as a 15-minute introductory phone call. It could be a 30-minute Zoom, or my preference, we can do an in-person meeting at any of our 3 office locations. Again, that's downtown Fairhope. We also have an office in Orange Beach. It's just right down the road from the wharf. And then we have an office over in Mobile near the intersection of Dolphin Street and I-65. However you reach out to us, make sure you do. We'd love to meet with you. All right, folks, coming up next, like Jay said in the beginning of the show, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement, and then we're going to give you our honest opinion about these headlines. So join us after the break to hear Jay and I discuss this week's relevant headlines in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host Josh Knoll here alongside guest co-host Jay Stubbs of Providence Partners. So as we discussed before the break, every week we scour the internet for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read these referenced articles ourselves, we include the links on our show transcript, which you can find, Jay mentioned it earlier too, on our website, gulfcoastfa.com. Just go into the podcast tab, find the individual episode you're looking for, and look at the show notes. You'll see these links. With all that said, without further ado, let's get at it here with the headlines of the week. All right, Jay, so first up is an article. It's from Kiplinger. It's an often referenced site here. It's called 5 Options for Retirees Who No Longer Need Life Insurance. This article is specifically for retirees that have permanent cash value life insurance, some we talked about in the show opening. Some of these options around permanent life insurance for those that decide that they no longer need life insurance include surrendering the policy, or a fancy way of canceling it. Then when you surrender it, you're looking to take the cash value out of that permanent policy if there is cash value. Or you can use the cash value to pay the premiums. In our industry full of jargon, that's called paid up, right? Is that reduced paid up? Reduced paid up, thank you. Or you can take loans against the policy, which we're going to discuss in greater detail. There's 5 options, so that was just 3. I do want to make sure we discuss the last 2 options, which many listeners may not know that are available. One of them is, in some cases, you can sell your policy. And we want to talk.
That's a life settlement. Option.
Yep. And there's a part of the industry, we want to make sure we're real clear on this, that has gotten in some trouble over the years, but there's a legitimate part of this business. And this one, a lot of folks don't realize there is the ability to do a 1035 tax-free exchange into an annuity.
That's right.
Yeah. So what say you on this article, Jay?
Well, covering the first 2, let's take the last one first because it's
right.
an easier concept to understand. If you have cash value life insurance inside of a policy that's built up in whole life or universal life for the last 15, 20, 25, 30 years, and we see a lot of it when we do policy reviews. A lot of people don't realize, well, they see it on their annual statement, but they're like, golly, that's kind of really humming along, and they have 6 figures of cash value sitting in there, and they're like, what do I do with this? Well, if you don't have an emergency need or an immediate need, if you don't have a need for the life insurance, you don't want to pay the premium anymore, you can take that cash surrender value, you can surrender it out, 1035 exchange, that's the tax-free tax code exchange, into an annuity, and you can buy any type of annuity you want. You can't go from annuity value to life insurance. It's a one-way street.
It's a one-way street. Okay.
You can only 1035 exchange life insurance cash value to an annuity. However, a lot of people don't understand you can 1035 exchange a life policy to an asset-based long-term care policy.
That's interesting. I didn't even know that.
Yeah, and it's a very, very meaningful conversation. So people think, I've been paying into this whole life contract for the last 2 or 3 decades. It's amassed a pretty sizable lump sum. It was there as an emergency. It's there now as cash reserves, an asset on the books, so to speak. We're going to cancel the well, before you cancel anything, have a conversation.
Right.
You may still need that life insurance policy, but if you are identified that the need is no longer there, you can say, hey, I am now ready to have a long-term care discussion. And we can reposition the asset into an asset-based hybrid long-term care plan and get guaranteed long-term care benefits to carry you through your retirement years. So that's a very important feature that a lot of people don't understand is we can 1035 to create income. That would be the annuity. We can 1035 to continue to grow the accumulation without any underlying fees. That would be an indexed annuity. We can get a 1035 to an annuity with a guaranteed rate of return. We're seeing guarantees in the mid-fives right now, Josh. So
on the MIGAs?
The MIGA, a 5-year multi-year guaranteed annuity is, I think, 5.3 if you had 6 figures or more to 1035 into it. Or we can 1035 into a long-term care plan. So lots of options with that cash value that you say, hey, we don't want to use this policy or need this policy anymore.
Yeah, and we did mention selling. We don't have enough time this episode to go down that because that's a fraught.
Let me hit it though real quick.
That would be great.
A life settlement. You might have seen some of these commercials where there's the people in the basement or underneath the lady's house, and she says, "What do I do with this $100,000 term life policy?" There are ways that you can settle or sell the policy to a company, and you want to make sure that the company is legit.
Right.
But what you're doing is selling a policy, and that company will settle with you for the contract value, and they will come to some agreement of, hey, you have a $100,000 life insurance policy. We'll give you, and I'm just throwing a number out there, $20,000 for that. Well, it may have been something you say, oh, I didn't know I could get that because there was no cash value built up in it. Well, they'll figure out a way to recoup when you die. They'll figure out a way to recoup the death benefit from you, and they have a net gain. So that's a business play. It's called a life settlement. Well, understand the life settlement marketplace is really for the unhealthy folks.
Right.
You get the most money from a life settlement company when you are
terminally diagnosed,
or a doctor has said, hey, start making plans.
Right.
And
congestive heart failure, things of that nature, where it's not getting better.
Cancer situations, right. And a lot of people can say, hey, I'd love to do something special for my family, or I want to travel. All that can be taken care of with the potential for a life settlement. So we do work with clients. We do have reputable companies that we work with that have been around for a long, long time. So Josh, if you have somebody that calls in and says, I'm interested in that, we have a couple of basic questions that we can ask them, and then we can take that next step forward.
Well, I think the main takeaway is if you are in a position where you don't need that you feel like you don't need that life insurance anymore, call a qualified professional, because there's definitely some options outside of just surrendering it and dealing with a tax situation. You have probably more options than you actually realize. All right, number 2, Jay, and we were talking about annuities a little earlier. I don't know if you're familiar with Stan the Annuity Man.
No, you have. I see this notes here, and I'm like, what is this? Tell me about that.
He's Big Lou's brother-in-law, I think.
The guy on the radio? Oh, wow.
I don't know. Well, I'm sure that name is a great pickup line for the ladies, but Stan the Annuity Man, he's we've referenced him before. He's a fairly prolific online explainer of annuities, and one of the reasons I kind of like him is even though he's a producer himself, I mean, it's a little bit self-serving what he does, but he takes a critical bent. He has an article titled MIGA, which we talked about earlier, real quick. That's a multi-year guaranteed annuity. I want to be careful with this explanation because they're not apples to apples, but it's the insurance industry's kind of equivalent of a bank CD. That's fair to say, right?
Yeah, where that bank CD is FDI insured. A MIGA product is guaranteed by the underwriting insurance company. So we want to look at A-rated companies or better when we're looking at MIGAs.
Perfect. So he's got an article titled MIGA to SPIA, Single Premium Immediate Annuity.
Acronym heavy today.
It is, yeah. And Michelle loves saying SPIA. For full control annuity income. I think Stan the Annuity Man, he makes an interesting case for a particular method of utilizing annuities to protect principal and produce income in retirement, which I want to discuss. But more importantly, this article gives us an opportunity to discuss the different types of annuities available to pre-retirees and retirees. And I wanted to make a quick note. I don't mean to steal your thunder, but multi-year guaranteed annuities usually come in 2, 3, 4, 5, 7, 10 years. Is that accurate?
Yes, you can buy them longer than that. We don't recommend anything longer than a 10-year period.
Yeah, and you've got on your providencepartners.org site, you've actually, under the resources tab, you've got a MIGA rate sheet that's updated weekly?
Weekly, yeah.
Yes.
Rates come out usually throughout the course of the week. We update that sheet, and then we populate that. It's a one-page PDF.
Well, let's talk about MIGA to SPIA, and then let's introduce a couple different annuity types here before we move on to our next article.
Well, it's important to understand that this is giving you more control because an annuity is an insurance company offered product, and all annuities have a beneficiary designation. So people will buy it for its accumulation, buy it for the MIGA guaranteed rate, buy it for the income that it could produce. All annuities have a beneficiary designation where the remainder balance can be paid out to whoever you put on there. So that's a nice control feature when you have an annuity and you are the annuitant. But you can say, hey, at my death, I want to make sure that this asset passes on outside of probate to the designated beneficiaries or beneficiary. The MIGA product is straightforward. We already talked about that. The SPIA product, single premium immediate annuity. Hey, I want to turn on an income stream. I'm going to put a large deposit in the product today, next month, and for the remainder of 5, 10, 15, you name it, years, I want to guarantee an income stream on a monthly basis to help me pay my living expenses during my retirement years. It's just like a pension check. For people that have a pension or are familiar with those, a SPIA is like your own personal pension plan. And it's guaranteed income, and it's going to have a set ending point. And a lot of people will stack and layer, Josh, the annuities. Right. Hey, I want to go get an accumulation annuity that I know has the potential to grow for the next 10 years. Then I'm going to go buy a 5-year MIGA. I know exactly what benefit or what value that's going to have in 5 years. And then I'm going to put a little bit of money into a SPIA that's going to generate some income. And then after 5 years, we take that MIGA asset, and then we put it into a SPIA and guarantee a 5-year or 10-year income period. And then fast forward, now it's 10 years later. Remember that money we put into the accumulation annuity, maybe an indexed product. We can now take that money, and again, 1035 exchange, you're moving it tax-free into another SPIA to create income. So all of the annuity products are designed, or you can design a plan that gives you a plan for the rest of your life. It's really quite simple. It's not something that you want to just make a rash decision on.
Right.
You want to sit down with an advisor and say, hey, I want to design an income stream around annuity products. And here's the asset that I have to work with. How can we design something that's going to help me pay expenses and live and have some fun in my retirement years?
Very good. All right. So Article 3, so far in this episode, we have concentrated on life insurance, planning, and retirement. We've talked a little bit about income planning and things along that nature with the discussion on annuities. But I'm going to take a bet that some of you listening are asking, well, the life insurance and the annuities, that's all well and good, but what about health insurance in retirement, especially for those of you that want to or can retire before age 65 and you become eligible for Medicare? This show has a quick pace. Regular listeners know that. And this is a somewhat complicated discussion that we could spend an entire opening topic on it. But what I want to do, Jay, was give the high points. And I also wanted to provide an excellent resource to this very question. We joked about this before. Michael Kitces is somebody in our industry that you and I both respect. And when I reference his articles, I always want to give a little bit of disclaimer. They are detailed, folks. So, I mean, if you really want to learn about a topic, go to a Michael Kitces blog post article. He's got one that's called Figuring Out the Quote-Unquote Best Healthcare Option for Early Retirees. I think this is a hugely important topic for those of you fortunate enough to retire before you're eligible for Medicare. It's not like health insurance is going down in cost. And I also know that Providence Partners has recently expanded, because I just went to a luncheon, their health insurance presence. So I want to give you an opportunity to discuss this with you, Jay. What do you think?
Well, thanks for the mention of the expansion of the health insurance presence. That is for businesses and employers in the state of Alabama that have 25 employees or more. We can now bring Cigna Healthcare to the marketplace.
That's a big thing.
That is a big thing. So if you're a business owner listening to this and you don't like the rate increase letter that you got from your specific health insurance company, which 85% of employers in the state of Alabama use one specific one.
Right.
Cigna is a very reputable health insurance. A lot of people recognize that name. Cigna Healthcare, and yes, we are a general agency in the group benefit space for that group health plan. But back to it, yeah. If you're not Medicare age friendly yet, meaning you have taken an early retirement, you do need to find a health insurance plan that's going to help offset those costs should you need to go to the regular doctor visits, exams, checkups. Once you hit the over age 50, there's a lot of poking and prodding, Josh, that goes on.
I would know.
I would know as well. But, men and women alike need to make sure that there is a good health care plan in place. Whether you switch it over to, somebody that's working in your family, you or your wife or your husband, you can go on their plan. Or you can go out to the marketplace and get an individual plan. Or you can maybe go join a friend's or an employer groups and be a part of their plan. But once you hit Medicare age, at Medicare retirement age, you have options that the government and Medicare companies can bring to you, and that's a good plan. But I'll always understand that the number one thing on the website at Medicare.gov that they say they do not pay is long-term care expenses.
Okay, right.
So you want to make sure that if you have a long-term care chronic illness event, that if you can't do 2 of 6 activities of daily living, or you have cognitive impairment, those are health care expenses that Medicare is not going to cover. And, it might be some of those early day expenses. I think it's 100 days of those costs. But after day 100, typically that's going to revert back to you, and you need to have a plan in place. A lot of people look at their assets at the position that they're in, and they say, well, I can self-pay. We don't recommend that, especially if something lasts a really long time. It can deteriorate your assets and the money that you want to leave to your children and grandchildren in a legacy capacity. And then also Medicaid. That's not an option either. But just think about health insurance. Think about maybe having a plan in place that's going to protect your assets, protect your family dynamic, and keep you in the home that you want to stay in. If you need care coming by, things of that nature, skilled nursing care can be taken care of, the cost of it, with a long-term care policy.
Well, I'm going to say 2 quick things before we move to our last article. One, folks, for those of y'all that are in that gap, we do recommend checking out the marketplace, because I think a lot of times people are surprised at the options that are out there. And 2, Jay mentioned self-pay. When it comes to health insurance, one thing that a lot of people don't realize is whether it's Cigna or Blue Cross or United, they have negotiated rates with these healthcare providers that you're not going to get on your own. So it really behooves you to have some type of plan in place. All right, quickly, Jay, because we're running a little short on time. Last article, I wanted to talk about a pivot to a risk management strategy that I would argue most, if not all, retirees should consider carrying, and we've touched on a little bit, long-term care insurance. Your site, providencepartners.org, again, has a great resource tab. It's got a lot of long-term care material around it to answer those questions. But I just wanted to quickly talk about the one-page guide you have, 6 ways to get long-term care insurance. Regular listeners will know that you and I have discussed long-term care insurance a lot in previous episodes, but I wanted to just kind of quickly run through that resource that they have for the ways to get long-term care.
Yeah, so there's traditional long-term care planning. You and I are working on a couple right now whose budget is limited, but they want a plan in place potentially, and so we can go and look in the marketplace for LTC and get them a traditional LTC contract. Then there's the asset-based contracts. We already discussed that. You can look at several different companies out there, and whether you do a single premium or a structured premium over time, you can get a long-term care policy that'll help you with those expenses. But there's also some features there that are unique to it, separate from traditional. 2 features that are important. It's guaranteed, never to rate increase, and the benefit you are buying is guaranteed. Traditional, you can't really say that because the rate could go up, down, in the future.
Can and will.
And then, if you never use it, long-term care traditional, you don't get anything for it if you never lose it when you pass away. Whereas on the asset-based side, on the hybrid LTC planning, you can. There is a beneficiary designation there. Then we already discussed it earlier in this topic, the life insurance, adding a chronic illness or a long-term care rider. We can look at long-term care planning using that rider feature. And then there are a couple of annuity products out in the marketplace that we can add LTC riders and really be tax efficient. That's really what the LTC annuity is. It's tax efficient. So you think about an annuity earlier, we talked about them. They generate income. You're going to pay taxes on that income. If you are generating a long-term care rider annuity, the benefit that comes in, if it's using that annuity proceeds to pay LTC expenses, that income coming in can be income tax free.
Very good. Last quick question before we close this segment. Can folks use the asset-based long-term care? Can people use qualified assets to purchase that, like in an IRA?
Yes. It's a longer, deeper conversation, but the answer is yes.
Short answer is yes. Very
Yes.
good. All right. Well, listeners, again, if you liked what you've heard, you want to set up a conversation about your own personal risk management and retirement planning, give us a call, 251-327-2124, or go to our website, gulfcoastfa.com. While you're there, go ahead and set something on my calendar. There could be a 15-minute phone call. It could be a 30-minute Zoom. It could be a 1-hour in-person meeting. I've got one scheduled for tomorrow down in Orange Beach from the radio show. Thank you, listeners. However you reached out to us, make sure you do it. All right, folks, coming up next, Josh's Crystal Ball and Big Mouth. On this particular episode, I'm going to throw the hot potato in Jay's lap, and we're going to talk about something that is all over the news right now, artificial intelligence. And we're going to get an update on where things stand around that in Jay's industry, and we're going to get some predictions. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll here. So, Jay and I are opinionated people. Otherwise, I think most of y'all would have already tuned out because we'd have been boring to listen to. We're also paid in our respective professions to offer professional guidance and opinions to our clients. Otherwise, we just replace us with AI. Speaking of AI, Jay, I want to use this section to discuss how AI, artificial intelligence, is already affecting your business risk management, and more fun, I'd like to get some predictions around the future of AI, specifically around our topic of the day, life insurance. If I don't know how you feel about this, but if you listen to some of the talking heads on TV or the radio, all of us in the service industries, folks, we should all be quitting our jobs and getting trained to be plumbers and car mechanics. Nothing wrong with that profession. I ran heavy equipment for a big chunk of my life. But if you listen to that, it's telling you that anybody in the service industry, life insurance agents, are we going to be replaced by Tesla service robots? Are humans becoming obsolete in the risk management industry because of AI?
No, because there's a human element to all of the planning, and I don't know that the emotional impact of retirement planning, estate planning, loved one passing away, premature death, I don't know that the emotional impact can be felt with an artificial intelligence computer right now. And while we are using AI to be efficient, for instance, we're getting very good summaries of meetings. We will upload content of notes and get good summaries of meetings. We're getting educational concepts. You can quickly ask ChatGPT or any of the other artificial intelligence platforms that are out there. You can get great insight from asking some very simple questions on all the AI platforms. Life insurance companies are already using AI in some capacity to help them underwrite an individual insured. When you answer the questions, they're put into underwriting manual algorithms. The AI component has sped that process up, where it used to take several days for an underwriter to review an insured's underwriting file to see if they're going to qualify at preferred or preferred best or standard rates for $1 million coverage. Now has taken a matter of hours or even minutes that the computer algorithm processing can spit that approval out, and it's really unique. It is Not anything that you can do for big life insurance policies, but we can go to some of these insurance companies who offer this quick underwriting. It's called accelerated underwriting. They are some component of an AI process. Accelerated underwriting, we can get approvals in sometimes less than 10 minutes, up to $1 million of coverage. So it's unique, and we are utilizing it to the best of our ability, but we have to be ethical about it. We're not asking AI to go out there and replace the insurance agent conversation. I don't think that could ever happen.
Well, two quick points before we end the show. One, in today's world, we're used to prices on things just going up, up, and up, right? Generally speaking. But for what you and I have been doing this long enough, do you think that, I don't mean to make this long-winded question, but do you think that AI has had some impact on the insurance industry's life insurance premiums in general becoming more affordable over the last handful of years?
Not yet.
Not yet.
We haven't seen it yet. We haven't seen it yet. And it may come at some point down the road where the insurance companies get more efficient and their operating costs come down. I do know that, operating costs at insurance companies, the first thing they want to do is make sure that they're giving back their dividend participations and they're pricing out their accumulation products such that they get more than the owner of those products gets more bang for their buck. When we look at true cost, insurance mortality costs, that's based on the mortality tables that are put out by the federal government and issued about every decade. So just remember that the mortality and expense tables are how life insurance is priced. We won't see a change in the underlying cost of insurance inside of products until people start living longer. Right. And that comes in AI and medical technology.
Yeah, that's fair.
All right. So we're probably a little ways off of seeing reduced cost in insurance premiums specific to death benefit.
Well, just to make sure I understand your prediction correctly, so you're saying 1 year from now, you and I our digital avatar AI robots are not going to be sitting here doing the show for us.
No. And they're not going to have the funny jokes that come with
awkward stuff.
Yeah,
we're good. We're awkward on our own.
Yeah,
so very
I
good.
will say that I'm a believer in daily use of AI to get some very basic questions in a quick and fair manner. I think it's great for students to be able to capitalize on it, not in a cheating capacity, but just to help them learn and comprehend and understand the concepts that they're being taught in the classroom and then the professors are doing at colleges. So I am a fan and I do use AI.
All right. Well, folks, I hope you enjoyed a little peek behind how we form our opinions and our predictions. We want to invite you one last time. If you want to have a conversation with us, give us a call, 251-327-2124, or go to the website, gulfcoastfa.com. Blue button up right-hand corner, phone call, Zoom, or my preference, let's meet in person. We have 3 offices, downtown Fairhope, Orange Beach, and Mobile off Dauphin Street and I-65. Reach out to us. Well, that's our show for this week. I want to give a huge thank you to my guest co-host, Mr. Jay Stubbs, and his company, Providence Partners, for being our longtime show sponsor. Thank you, buddy.
Absolutely.
Yes, thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, that is local band Sloth Racer. Huge thank you to the show producer, that is my son, Peyton Knoll. And as always, our sincere appreciation for all of you out there that have been joining us on this journey. We'd love to be part of your journey as well. Until we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.